Okay, let's see how to look at an option chain. We are in Robinhood and we are looking at an options chain for Apple, which closed today's day at 312.26. Today's date is May 28. We are looking at calls and we are looking at expiry of June 26, which is 29 days from now. So if you see here, 312.27, which is the closing price marked here, that is the line which is dotted here. So basically it is showing something called strike prices, which are above and below this value. So all these strikes, 315, 320 and so on, which is separated by $5 each, they are higher than this. And then 310, 305, 300, these are all lower than this. So first we look at the money options. So the two strike prices which are closest to the current price, so 315 and 310, the one which is slightly higher and one which is slightly less, they are called at the money. Now if you want to look at all the other ones, so these ones, 320, 325, 330, 335, 340, these are all what we call as out of the money call options. So basically what they're saying is they are way higher than the current stock price of 312.26. So they are at 320, 325 and so on. And in a similar way, if you want to look at in the money call options, you have 305, 300, 295 and so on, which is basically saying they are much less than the current stock price. Which one do you want to buy? Well, it depends on what you want to do and what is your risk tolerance, right? So the at the money call options, if you see this one, this is a very nice indicator, chance of profit. If you buy this one, it has a 32% chance. And if you buy this one, you have a 36% chance. So these two have what I would call, these two have something like a medium percent chance. We look at all the out of the money call options. So let's look at first at 320. So if you look at 320, the chance of profit reduces slowly at 26.85. But because the chance of profit reduces, even the cost reduces. So the at the money option was at $695. One option controls 100 stocks, so this is $695. Whereas this one, 320, is only $483. So your initial risk is low, but then also your chance of profit is low. So now if you go even further out of the money, right? So 325, the cost is 316, but the probability of profit is only 21%. As you go further and further out of the money, it'll be cheaper and cheaper to buy, but the chance of profit will be lower and lower also. If you look at in the money options, look at 305, which is at 12.75. So $1,275 per contract. And the probability of profit is 40%. And then if you go to 300, it's much expensive. It's 1633, but the probability of profit also rises. So that's why you're paying more, because it's higher probability of profit. Okay, and if you go to 295 strike, if you see the buying price is 20.23, which means close to $2,000 per contract. But that also means you have a higher probability of profit, 45%. If you're trying to decide which one to buy, at the money call options will give you sort of like a medium risk, medium profit. Out of the money call options have lower risk because they're cheaper, but then very low chance of profit. In the money options are more expensive to buy. They have a higher chance of profit. So if you ask me for this video, I usually buy in the money options because they are more expensive in the beginning, but they have a higher chance. You should always look at the chance of profit more than just the initial price. So thanks for watching this video. If you have more questions about calls and puts, watch the other videos which I've put them here and here. Thank you.